Welcome back. The Naira is seen weakening on the black market in the coming days as demand for the dollar increases, but is expected to trade within a range on the investor forex window and official interbank markets. The local currency was quoted at about 305 Naira 65 kobo a dollar on Thursday. An FX dealer at Diamond Bank, Adam Bachu, joins me now to review the currency's market's performance this week. Many thanks for joining us, Ada. Now, it's that time of the year when there's a surge in demand for the dollar by summer holiday makers and, of course, parents making payments for school fees for their children abroad. How has this impacted on the Naira performance this week?
Good afternoon, and thank you for having me. Following the increased demand, we have seen a lot of activities in the FX market, but the central bank has been consistent with their support to ensure the stability of the Naira through their various interventions in the various facets of the market. We'll see the market at the interbank level open at 305 and close at 305.15 this week, representing a slight depreciation, while the parallel market actually opened at 369 and closed at 370 as of yesterday, representing a slight depreciation as well. But looking at the various windows in the market, we have the SMEs and the invisible windows. We see the continuous support by the central bank to keep the Naira stable at 360. So given the increased demand of FCY, on dollar, we have not seen a significant adverse movement in the currency. We have seen stability so far.
Now, with the stability seen so far, just like you mentioned, and of course the interventions by the CBN, what direction are we likely to see the Naira next week?
We will not see so much movement in the Naira next week, as I said, given the continuous support. And of course, the increased activity in the I&E window. So we'll see the Naira, the US dollar to Naira trading at almost the same level. For the interbank, we see them at the 305 level, while the parallel market will still remain between 369 and 370 levels. And for the I&E has actually been pretty active, and a lot of volume have actually gone in there. And that's why we saw a significant appreciation of the currency. So we hope to see more injections into the market. And for the currency rate, we'll see it between the 360 levels as well. So what we will see is a general convergence of currencies at the 360 levels.
Head fixed income dealer at Diamond Bank, Adam Bachu, thanks for talking to us in Business Incorporated. Moving on now, a new research by the Economist Intelligence Unit has projected that Nigeria is in position to hit $50 to $75 billion from Africa's e-commerce industry within the next 5 to 10 years. Hinged on the basis of its high business environment opportunity, the projections rely on the emergence of shopping malls now replacing informal structure of retail businesses. Other indicators in the EIU report include a newer trend of e-commerce as well as an expanding middle class. Using a metric of per 100 people, Nigeria returns 80.4 out of 100 to lead other countries with the highest potential opportunity in Africa's e-commerce space. A new development bank set up by the BRICS group of emerging economies plans to lend $1.5 billion to South Africa for infrastructure projects over the next 18 months. The BRICS, Brazil, Russia, India, China and South Africa agreed to create the infrastructure-focused lender in July 2014 as an alternative to the World Bank, launching it a year earlier. The bank, headquartered in Shanghai, officially opened its African Regional Center in Johannesburg on Thursday, which will identify projects that it can fund. The NDB was created to address a massive infrastructure funding gap in the member countries, which accounts for almost half of the world's population and about 1/5 of global economic output. It was founded with an initial authorized capital of $100 billion and started lending last year, funding 7 projects worth $1.5 billion. A report by global consulting firm McKinsey has shown that there are 930 Chinese firms operating in Nigeria, as against the 317 firms documented by the Chinese Ministry of Commerce. McKinsey's findings, which suggest that 65% of Chinese firms in the country go unaccounted for, puts operational Chinese companies on the continent at over 10,000. Chinese firms' total revenues come to $180 billion, but is predicted to rise 38% to $250 billion by 2025. With one-third of the firms reporting about 20% profit in 2015, the companies employ some 300,000 local workers. Nigeria is one of the African countries yet to match same level of engagement with China as Ethiopia and South Africa. In the meantime, a Reuters survey shows South Africa's Reserve Bank may cut interest rates again in November and possibly even September, given the relatively tame inflation outlook. The central bank unexpectedly cut its repo rate by 25 basis points to 6.75% for the first time in 5 years in July, taking advantage of slower inflation to support a sickly economy. With inflation slowing to 5.1% in June and expected to average just 5.4% this year and 5.2% next, economists suggest the bank could go for growth and cut rates by 4 percentage points by year-end and finish next year at 4.75%. Growth is expected to remain poor, averaging 0.6% this year and 1.2% next year. And the International Monetary Fund is projecting a real growth of 6.7% to the Guinean economy in 2017. This is supported by dynamic activity in the mining and construction sectors and good agricultural performance. Average inflation is expected to remain moderate at 8.5% in 2017. The projections come after an IMF fund mission visited Conakry to negotiate a new program that could be supported by an extended credit facility. The global finance body is optimistic that the Guinean authorities' economic policies and reforms program would, among other things, strengthen macroeconomic resilience, preserve debt sustainability, and improve the business climate to support private sector development. And that's our program today. Thank you for watching. I am BC Adebayo.